Hey everyone, welcome back to Chipstock Investor. Today we're going to be talking about the recent software stock meltdown, especially in the light of two companies that we've held for some time, especially Salesforce. We've had that for many years, but also UiPath. Both of these companies had quite the downturn in the last week or so. What are we doing after this in cloud software stocks?
And Casey, in times past, it's always whenever there's a sell off like this, Salesforce down over 20%, UiPath over 30%. Oftentimes the question is it time to buy the dip? I think the more frequent question we're getting after these particular downturns is it time to sell and move on from these companies? Is cloud based software as a service or SaaS, is it broken? Is it time to sell because the market is just completely fixated now on hardware, on semiconductors, on AI systems, thanks NVIDIA. So let's get to it. Let's answer that question. Are these companies done for?
Let's start by taking a look at our hierarchy of the economy chart. Nick, why don't you explain where Salesforce and UiPath fit into the economy?
We have them placed in the middle between the traditional economy and the digital economy on the right. Both of these companies help predominantly traditional businesses make good use of their data, or UiPath, which we'll talk about second, helps those traditional companies automate redundant tasks. But Salesforce in particular, we're starting with that. We have them a bit higher up, closer up to the top of the hierarchy of the economy funnel, the really massive multi-trillion dollar per year spending products and services segment. They help these traditional economy businesses sitting on massive amounts of data about their customer, about product sales, about their operations, whatever, turning that into actionable insights, actionable data and information. So we have them definitely as an infrastructure software play, but also a bit higher up in products and services, especially digital products and services, because ultimately that's what they do. They help their customers enhance and get the most out of what they do.
Let's take a look at the breakdown for revenue that Salesforce brings in. You can see that sales and service portion at the top making up their older core business. And then they've added some acquisitions in the last few years. You can see Slack in platform, and then marketing and commerce being a portion of their business. And then that integration and analytics, that's where MuleSoft and Tableau come in.
Q1 fiscal year 2025, which ended in April of 2024, from top to bottom, Salesforce still growing their subscription and support revenue, growing number of customers and growing the number of seats, the number of users per software license. Simple answer to the question at the outset, is software as a service done? Is it finished? Is it dead? No, absolutely not. In our opinion, I think this chart answers that question pretty succinctly. Salesforce very much still a growing business.
So that begs the question, why the 20% drop in stock price? That's most likely due to this revenue quote unquote miss. Take a look at the guidance from 3 months ago. You can see the total revenue was in the range of 9.12 to 9.17 billion, with the full year guidance being between 37.7 and $38 billion. Let's take a look now at the results of the most recent quarter. You can see that total revenue came in at just $9.13 billion, which is definitely at the low end of that guidance that they had provided 3 months ago. This was still an 11% year over year increase, but management left its full fiscal year 2025 revenue outlook unchanged. And so that really just breaks from Salesforce's long habit of beating its own guidance and raising it for the year.
Yeah, and definitely a departure from co-founder and CEO Mark Benioff's 2-decade-plus run of trumpeting how fast of an enterprise software story they've been. One of the largest software companies on the planet, still obviously behind giants like Microsoft, but in a matter of just 25 years, this company is massive. And I think the market is basically just still coming to terms with the fact that this is not a 20% plus revenue growth story anymore. In fact, it may not even be a 10% plus revenue growth story anymore, at least not on the average CAGR expectation going forward for the next decade. We probably have to get used to just saying maybe a high single digit revenue growth rate from this point on.
Let's take a look at that guidance slide for Q2 fiscal year 2025 and focus in on the operating margin. GAAP operating margin at 19.9% and non-GAAP operating margin 32.5.
This is another reason for some shareholder angst. So the full year guidance for adjusted operating margin was actually left unchanged. We're going to get to that here in just a moment, but the GAAP operating margin down from 20.4% before. So not a massive cut to profit margin guidance, which, by the way, on a GAAP basis and an adjusted basis, these are both profit margin expansions from prior years. I think this is where investors have some big questions about SaaS and the cloud. It's because, as we talked about with our Snowflake video last week, Casey, suddenly NVIDIA has these new services built atop their AI systems. Let's call them, just for the sake of simplicity, AI algorithms that help their users custom build their own software. And that seems to have changed the amount of demand that big corporations have for out-of-the-box, ready-to-use software like what Salesforce offers. There's maybe a little bit of discretion going on where some of these corporations are saying, hey, we're going to be investing in this NVIDIA hardware. Can we maybe make our own software rather than buying a general purpose piece of software from Salesforce? I think that's the worry now, is that some of these profit margins are taking a dip because some of these software companies are going to have to invest as well to keep pace with the competition.
We're going to get to this tweet by Mark Benioff boasting about the profit margin expansion for Salesforce over the last 10 years. But before we get to that, let's talk about whether or not AI is going to upturn Salesforce. That seems to be the big question right now. Nick, why don't you tell us a little bit about this quote from Bill Patterson, who is the general manager and executive vice president of CRM applications. And he said something at the Jefferies Software Conference at the end of this month, which was just the day after earnings.
Because this is exactly the same question that he was asked at the conference. Is AI completely changing the demand dynamic? And there was an acknowledgement that, yes, we are at the end of the world as we know it for SaaS software, but Salesforce still feels fine. Sorry for the corny REM music line quote. But he acknowledged that while there are changes in demand because of AI, ultimately, companies still have this data that's running around their Salesforce cloud. And Salesforce, they feel, is in a good position to help them continue to unlock the value of that data. So cited a couple of examples like Rocket Mortgage using Slack plus sales and service and marketing clouds to rewrite the script on how they acquire customers for mortgage services. So at this point, yes, while the story has changed, I almost want to say this is just maybe part two of the same chapter as 2023, where a lot of that AI growth is currently accruing completely to NVIDIA. And as companies invest in that accelerated compute infrastructure and try to figure out, okay, now what do we do with it? The growth just hasn't trickled down to Salesforce yet. That's the messaging that we're getting at this point. We're going to continue to monitor that, but I want to say this is just a repeat of 2023 at this point. So we're not on high alert just yet with Salesforce.
Let's go back to this tweet from CEO Mark Benioff. You can see on the left side, revenue growth, but then on the right side, operating cash flow growth. It seems that he has really shifted in the last couple of years. Instead of trumpeting that revenue growth, he's focused more on profit margin expansion.
Yeah, Benioff, definitely a bombastic personality that not everybody likes. But like it or not, the runaway enthusiasm has shifted to profit margins. What I find ironic about this, Casey, is the profit margin story has always been there. This is the free cash flow per share growth over the long term. And We always cite this in per share basis because it actually counts for stock-based compensation, which everybody really attempted to dunk on Salesforce during the bear market. The numbers speak for themselves. I don't know what people were thinking. I think it was just a lack of understanding what the business has accomplished over the long term. This has always been a profit margin expansion story.
Just in the last 5 years, you can see that free cash flow per share has almost tripled. Back in 2019, it was $4.30, and now it's 11.50 cents.
And yes, on a GAAP basis, Salesforce is now getting its GAAP profitability in order. It's getting stock-based compensation under control. Why did the GAAP profit margin take a slight hit as far as guidance goes for fiscal 2025? Again, probably they're going to be making some investments of their own into new products utilizing AI. But ultimately, this story remains the same. It's a free cash flow per share growth story that's been in existence for a long time. And as you said, Casey, there's been a pivot towards talking about this more frequently. This is the kind of stuff it leads to. Check out the capital returned just since they announced that share repurchase program at the beginning of last year. Almost 14 billion worth of stock repurchased out of the total 30 billion share repurchase authorization that they have. They had their first ever quarterly dividend payment, which is very small at this point. Not going to write home about how great that is yet. But at the end of the day, this is what free cash flow focus does for a business. We think Salesforce is at the beginning stages of what could be a fantastic new era for the business.
You can see that the stock price is still up 50% in the last 5 years. Currently, as of June 3rd, the stock price is around $236 per share, even after that 20% dip in the last few days.
Yeah, so the stock, as we record this, trades for 20 times trailing 12-month free cash flow. That seems like an entirely appropriate valuation, if not a cheap valuation, if you think that this profit margin expansion story continues, and especially if that slower growth, for sure, slower revenue growth, but higher profit margin along the way trickles down into lots of more stock repurchases in the coming years. This could continue to be a fantastic compound growth stock for many years to come. Is Salesforce dead? Absolutely not.
Before we talk about what we're doing with our Salesforce stock that we own currently, let's now shift to UiPath. Company also reported earnings recently, and the stock took a serious hit. The last quarter was solid, but the path forward seems a little bit more murky.
And maybe this all seems a bit crazy because isn't AI supposed to be some sort of like magic talisman that guarantees the stock price stays elevated? If you look at what UiPath does, this is software-based robotics and automation, aka AI, and they help companies do everything. It's a virtuous cycle type of platform that helps companies discover inefficiencies in their operation, figure out how to automate those redundant tasks or those tedious tasks that humans don't want to do, and then helps with the deployment of the actual software robot itself. So maybe just a very simple, crude example here. Maybe you're a financial firm and you have customer data, and that data needs to be filled out into a form or into a document. UiPath's software-based robot can collect all that customer data and then populate it onto that form, just as an example. Obviously, that would be a huge investment initiative if, let's say, you're a financial institution and you're figuring out how to automate some of these tasks. It's just not worth paying someone to fill out a form anymore when you have technology like this. So what's up? Why did this thing get absolutely clobbered? Casey, let's maybe start again like we did with Salesforce. What was the outlook 3 months ago, and what did UiPath say?
So 3 months ago, let's take a look at the full fiscal year 2025 expectation for UiPath. Revenue was in the range of 1.55 billion to 1.56 billion. Annual recurring revenue in the range of 1.725 billion to 1.73 billion. And then a non-GAAP operating income of around 295 million. Now let's take a look at the revised outlook for the full year 2025. You can see revenue in the range of 1.405 billion to 1.41 billion. And then that annual recurring revenue, 1.66 billion to 1.665 billion. So very narrowed range. And the non-GAAP operating income all the way down to 145 million.
As you said, the actual Q1 results were solid. Revenue actually increased in the first quarter by 16% year over year at the very top end of management's guidance. But obviously, they're seeing a pretty big deceleration in revenue for the rest of the year, and the profit margin expected to take a header. So just like Salesforce, Casey, software as a service, no, it's not dead. Even with the revised ARR, annualized recurring revenue of 1.66 billion, let's call it, that's still up 14% year over year. UiPath's still a growth business, but the adjusted operating margin, that's a big deal. Shaved all the way down to 145 million. They were expecting a 20% adjusted operating profit margin before. Now they're just expecting a 10% operating profit margin. We're going to come right back here to the profit margin story because that's significant. But let's maybe first introduce it with the CEO situation. Rob Enslin is out as of June 1st as the CEO. He was actually brought in 2 years ago during the bear market to help UiPath navigate what was at the time all about fixing the software business model, getting UiPath profitable. Remember, a couple of years ago, it wasn't profitable yet, not even on a free cash flow basis. He helped do that, introduced a share repurchase program, but Enslin is out after 2 years on the job, first as a co-CEO, then as just the sole CEO, and then co-founder and chief innovation officer, at least up until June 1st, Daniel Dinesh is back in as the sole CEO. So at least in our mind, we believe this is a pretty clear signal. UiPath sees the need to get really aggressive again on product development and bringing new AI and automation capabilities to the platform. And that revenue guidance cut seems to tell the story. You can see the Wall Street analyst crowd completely hacking their estimates for the next 2 years, expecting this to basically be a 10 to 15% revenue growth story for the next 2 years. Casey, is this another case of NVIDIA accruing most of the AI market growth to itself and really turning the screws on software as a service companies?
Ultimately, I guess the answer is yes, in a way. Massive amounts of budgets from businesses have really pivoted to investing in accelerated computing systems like NVIDIA's. And along with those systems, NVIDIA has plenty of algorithms that help the customers build their own custom AI applications. Things like UiPath's out of the box, ready to use subscription software isn't as trendy as it used to be. As an example, you can see this brand new product that NVIDIA deployed, NVIDIA NIM. NIM stands for NVIDIA Inference Microservices. And its goal is to speed enterprise AI application deployment from weeks to minutes. It's ready to be used on clouds, data centers, or workstations, giving their customers the ability to generate AI applications for copilots, chatbots, and more in a very short amount of time.
Just an example, pretty incredible. So if you're a business, you already have this NVIDIA accelerated compute installed, it's being used. Maybe your tech team, you're not a tech business, but you have a tech team now to help set this stuff up and get it working. And they make a copilot for your business based on your company's proprietary data. And maybe that copilot can accomplish something very similar to what the UiPath robot is able to do. Let's say like mining customer data and helping fill out the form. So suddenly, as you said, maybe it's just that UiPath isn't as trendy as it was because a lot of businesses have already pivoted to this accelerated compute platform. So all of a sudden, UiPath's revenue growth expectations getting whittled down pretty aggressively. And I promised we'd come back to the profit margin story because obviously with the adjusted operating margin getting halved, expected 20% before, now just 10% for the current fiscal year, that's going to hit free cash flow as well. So the free cash flow growth story is getting deprioritized at UiPath. So this is much like we talked about with Snowflake. We now have a revenue deceleration and profit margin contraction situation going on. Absolutely not what the current economic environment demands. And ultimately, I think we can say this means UiPath has recognized that it has some catching up to do. It needs to make some innovation for its customers, and that's going to cost money. So this free cash flow per share growth story is stalling out. We were pretty optimistic about it 3 months ago, and management completely changed the narrative.
Let's maybe draw some comparisons now between these two companies. You can see Salesforce on a free cash flow per share basis headed back up in the right direction, $6.20 on a quarterly basis in Q1 calendar year 2024. And UiPath on a quarterly basis, just 20 cents per share. And you can see the line is quite flat. So let's maybe sum this episode up by talking about what we plan on doing with our shares of both Salesforce and UiPath. We'll first take a look at this stock price for UiPath. It is down in the dumps.
Yeah, back almost to all-time lows since the IPO. As we said with Snowflake, slowing revenue growth is fine if you're at the very least keeping your profit margin stable. That's not happening here. Unfortunately, our enthusiasm on making this a dollar cost average stock a few months ago was misplaced. So that's off the table. And UiPath, we have to take a hard look at. It would be nice to maybe see one more quarter from management and see what they say about progress. This doesn't look like a quick fix situation, and I worry that this might be a value trap stock at this point. So stay tuned on this. We may be orchestrating something of an exit from UiPath, and maybe the money, the proceeds, it's not a large part of our portfolio. It's a DCA stock. We rank as a small cap stock in the enterprise software market. Maybe it just needs to go into that Vanguard Information Technology ETF, VGT.
As for Salesforce, this company already holds a full position for us in our portfolio. But if we were looking to add, as Nick mentioned before, the stock trades for 20 times trailing 12-month free cash flow, which is a rather attractive looking price. So our plan at this point is to hold that position and be very content with that.
Yeah, most of the time, best course of action is do nothing, sit on your hands. So that's what we're doing.
That's only in investing where that's the case.
Naturally, we're not giving any other life advice or investing advice for that matter. This is just what we're doing with our portfolio. Sitting on our hands for now. We'll keep you up to date on UiPath.
That's a wrap for this episode of Chipstock Investor. Make sure you have hit that subscribe button. We have much more coming your way. We have some discussion on Airbnb, as well as some upcoming videos on the cybersecurity industry, including a look at CyberArk, a small cybersecurity company.
And remember our Discord channel available via our Semiconductor Insider membership. If you have questions, most of them have already been answered over on the Discord channel. Seriously, folks, at $5 a month, we know you're spending a lot of money on other subscriptions on things like Netflix, Disney Plus, Hulu, Peacock. Basically, you're paying for a cable package. Just add the Chipstock Investor Semiconductor Insider to your list of entertainment subscriptions.
All right, see y'all soon at Chipstock Investor.